All right, let's jump right into FiscalNote's third quarter earnings, because this was a big one. After a whole year of selling off business units and trying to refocus, this call was really the big test. The main question on everyone's mind, is this turnaround plan actually working?
So here's how we're going to break it down. We'll start with the headline numbers, then we'll dig a little deeper into the real operational story. After that, we'll look at management's playbook, the headwinds they're facing, and then we'll give you our rating and a potential trade idea.
Okay, so right off the bat, if you're just looking at the headlines, you'd probably be a little worried. The top and bottom line numbers, well, they both came in below what Wall Street was hoping for.
Yeah, you can see it right here. On a GAAP basis, earnings per share missed by a pretty wide margin. And revenue, same story, fell a bit short of the consensus. So if you just stopped right here, you'd think, oof, that looks like a rough quarter.
But, and this is a really big but, that is not the whole story, not even close. Once you get past those noisy headline numbers, which are all messy because of the businesses they sold, the story underneath is actually one of resilience. This is where it gets interesting.
Let's start with profitability. This is now the 9th straight quarter, 9 in a row, of positive adjusted EBITDA. I mean, that's more than 2 years of consistent cash generation. It really proves that management has a tight grip on costs.
And look at the margin itself, 10%. This is the 5th quarter in a row they've hit that level or even higher. Now, to pull that off on lower revenue, that shows some serious operating leverage. They are absolutely controlling what they can control.
Okay, now for the most important metric of all, annual recurring revenue, or ARR. That reported number, down 22%, looks kind of scary, right? But remember, that number includes the impact of selling off 3 businesses. The pro forma number, the one that adjusts for those sales, that one shows a much more manageable decline of 8%. That's the number that tells you how the core business is really doing.
So here is the crucial point, maybe the most important takeaway from the entire call. Sequentially, so from Q2 to Q3, that core ARR actually ticked up. Okay, it was only by $100,000, but this is a massive signal. It suggests the business has finally found its footing and is starting to stabilize after a really long transition period.
And their customer health is getting better too. Pro forma net revenue retention hit 98%. That's a solid 200 basis point jump from last quarter. What that tells you is that their core customers are sticking around. The bleeding is stopped. They're holding on to their clients.
Now, this stabilization isn't just happening by accident. Let's take a look at management's playbook. It's all about product innovation and a really focused go-to-market strategy.
The CEO, Josh Resnick, he said it perfectly on the call. He called it meaningful progress. And the subtext there is that this isn't just about cutting costs to survive, it's about building a much stronger foundation for the long run.
And the engine for all this is their core platform. They're just shipping a ton of new AI features. We're talking about tools that help you draft legislation, listen to social media for policy trends, and instantly compare different versions of a bill. This is real, tangible value that automates their customers' workflows.
So does this new tech actually work? Well, the data says yes. Their win rates with new corporate customers are up a massive 800 basis points in just the last 6 months. The product is clearly resonating with people.
And they're not just winning more deals, they're winning better deals. 50% of their new business is now coming from multi-year contracts. That's up from only about 20% at the start of the year. This is a game changer. It gives them so much more visibility and locks in customers.
Of course, it's not all smooth sailing. The company is dealing with a pretty significant external problem that's putting a lot of pressure on a key part of their business. The main issue here is the U.S. government shutdown. This kind of thing just creates uncertainty, right? And for their public sector clients, that means contracts get delayed. It's a real problem for a segment that has historically been a very stable source of growth for them.
And management was really transparent about the financial hit here. They figured the shutdown is going to cost them somewhere between $2 and $3 million in revenue for the full year. That's a material headwind that their strong corporate business has to work extra hard to make up for.
So how does all this shake out in their forecast? Well, they narrowed their full-year guidance. Revenue is now expected to be between $95 and $96 million, with adjusted EBITDA right around $10 million. The key thing here is that both of these new ranges are still inside their old guidance, which, to me, that signals confidence, even with those federal headwinds.
Okay, let's put it all together. With all this data, we can finally weigh the arguments for and against the company and assign a rating looking ahead to the next quarter.
You've really got 2 competing stories here.
The bull case is clear. ARR is stabilizing, the corporate side is winning, they're consistently profitable on an adjusted basis, and the AI strategy seems to be working. But the bear case is just as clear. The stock's been crushed, headline growth looks bad, the federal business is a problem, and they're still losing money on a GAAP basis.
So our rating for the next call is market perform. The green shoots in the operation are absolutely real and they're very encouraging, but you just can't ignore the severe underperformance of the stock, which shows that the market is still deeply, deeply skeptical. Management has to keep executing flawlessly to win back that confidence. The turnaround is happening, but the risks are still high.
And that brings us to our last question. You've got this classic situation. The stock is near its lows, but the fundamentals are actually starting to look better. It's a real conflict. So how would a professional investor even think about playing this?
Well, here's one plausible, though definitely speculative idea. We're calling it the strategic review catalyst trade. The thesis is that the market is overlooking the company's ongoing strategic review, so the action would be to build a small position at these depressed levels. The catalyst you're playing for isn't the next earnings report, it's an announcement from that review, maybe a take-private offer, maybe a strategic sale, something that could force the market to reprice the stock. The risk, of course, is that the review ends with nothing and the stock just keeps drifting lower. It's a classic high-risk, high-reward bet on corporate action.
This is not financial advice.